Ladies and gentlemen, on behalf of management of Dabur India Ltd, I welcome you to this conference call pertaining to results for the quarter and 9 months ended 31st December 2017. We have with us Mr. Sunil Duggal, CEO Dabur India Ltd, Mr. Lalit Malik, Chief Financial Officer, Mr. Ashok Jain, Vice President Finance and Company Secretary, and Mr. Ankush Jain, Head Financial Planning and Analysis. We'll start the call with an overview of the company's performance by Mr. Duggal, after which the Q&A session will open. I now hand over to Mr. Duggal.
Thank you, Gagan, and good afternoon, ladies and gentlemen. Welcome to Dabur India Limited's conference call pertaining to results for the quarter and 9 months ended 31st December 2017. Comparable consolidated constant currency sales growth was 12.9% for the quarter. Domestic FMCG business witnessed comparable growth of 17.7%, driven by strong volume growth of 13%. Profit after tax reported growth was 13% for consolidated and 16% for standalone business respectively. The category growths being discussed in this presentation refer to the underlying growth after adjusting for GST impact. The home and personal care vertical posted growth of 23%, led by all-round strong performance of all categories. Oral care grew by 23.2%, with growth of 26.1% in toothpaste. Red franchise continued to perform well, driven by increasing penetration, aggressive marketing, and visibility initiatives. Babool and Meswak posted strong double-digit growth, and market share in toothpaste category reflected an increase YOY. Hair oil category registered growth of 16.7%, with both coconut and perfumed oil segments performing well, despite continued decline in the CSD channel. Excluding CSD, hair oil category grew by 21%. Perfumed oils reported growth of 13%, including CSD, and 17.6% excluding CSD. Corresponding growth in coconut oils was 32.8% and 35.7%. Market share in hair oils moved up by 90 bps vis-a-vis the same quarter last year. Shampoos posted growth of 56% on the back of relaunch of Vatika shampoos. The brand was supported by focused marketing activities and ATL spend. Home care posted a strong performance, growing by 36%, backed by high growth momentum in Odonil and Sanifresh brands. Odomos had a muted quarter on account of relatively lower incidence of mosquito-borne diseases and lower institutional sales. Skincare registered growth of 14.5%, driven by Gulabari Rose Water, which grew in strong double digits. Supply issues hampered growth of Gulabari Cold Cream. Fem and Oxy bleaches posted robust high teens growth. The healthcare vertical reported growth of 16.6%. Health supplements grew by 19.5%, led by strong performance of Chyawanprash and honey, despite slowdown in the CSD category. The category recorded healthy 27% growth net of CSD. Dabur Honey recorded growth of 33%, including CSD, and 40% excluding CSD, and also gained market share. Digestive category performed well, growing by 19.3%. Hajmola tablets and Pudin Hara reported double-digit growth. OTC and ethical grew by 8.7%. OTC products such as Lal Tel, Honitus, Ashoka Risht, and Dashmola Risht ourselves posted good growth, backed by marketing initiatives and activation. Foods business was flattish this quarter, mainly on account of high base of last year, when the business had grown by 52%. In addition, Diwali gift sales got impacted as Diwali came earlier and the gift pack loading shifted to Q2 instead of Q3. Although sales growth was muted, profit margins in foods saw good improvements on account of lower consumer promotions and network optimization. International business reported constant currency growth of 5% during the quarter. Saudi Arabia, which had been under pressure for the last few quarters, witnessed a strong revival with growth of 34%. Overall, constant currency growth in GCC markets were 20%. Egypt witnessed high growth of 45% and Sub-Saharan Africa 21%. Translation impact of 66 crores impacted top line. However, this impact is reducing as currencies are becoming comparable to last year. SAARC business posted good growth led by Pakistan and Nepal. Consolidated operating profits increased by 28% and operating margin expanded from 18 to 20.5%. If we exclude the GST impact, improvement in operating margins were around 180 basis points. A&P spends in the domestic business saw an increase of 31.6%, while A&P spends in international business were lower due to business environment still not being very supportive. SG&A expenses reflected some savings on account of cost synergies. PAT reported growth of 13% instead of higher depreciation and lower treasury income. Post the GST implementation, the channels had seen some disruption which seemed to have stabilized. The implementation of the e-way bill mechanism is likely to throw up some more challenges in the future. However, the business is on a strong footing with revival in volumes and momentum of brands. We will continue to invest strongly in our brands, distribution and other infrastructure to grow ahead of the market and enhance shareholder value. With this, I now open the Q&A and invite your questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, congrats on very good performance. My first question is on the foods business. If you could tell us how is the market share, what has been the impact of ITC, and what percentage of food business is culinary, and if you could discuss the supply issues, what exactly is happening there.
10% of the business is culinary, 90 is beverages, so it's substantially dominated by beverages. In terms of competition, the challenges have not really come from the higher price competition like ITC, but it's very deep discounting by the mid-level players like Paperboat, etc., which have been able to gain some share on the back of these promotional activities, and also a lot of value players emerging in the segment. But keep in mind a very high base of 57-56% growth or thereabouts last year. The foods businesses are not really materially impacted by demonetization to that extent. And also the fact that a lot of the sales come from the Diwali gift packs, which this year happened substantially in Q2, whereas last year it was Q3. So there is a base issue on that account. Now going forward, I think we would see stabilization of beverage volumes. A lot depends upon consumption, recovery, etc. in urban markets. But definitely we will see growth ahead. We hope it will be double-digit growth, not to be taken as a given. But what we will be doing is that we are sitting on substantially enhanced margin in the foods business on a YOY basis. We will be willing to sacrifice some of those margin gains to drive the top line stronger. And we are beginning that journey now. The results, I'm sure, will come.
So this margin sacrifice strategy, will it help in combating a small player like Paperboat? I understand you had launched a product in the category of Paperboat, I think Hajmola cooler. So how has that done? So do you expect that this will be enough to combat them?
We think so. I think Paperboat in its new avatar is no longer that single serve format. It is really 1 liter. And basically on the same platform as our beverages. So there's no huge difference in terms of proposition given by Paperboat in the 1 liter, which is the one which is being discounted, and what we have. So I think we need to lubricate the trade more. We need to advertise more, and there is obviously a strong consumer preference for our brands, which should translate into business once the price levels are a little bit more stable.
And so this culinary business, what was the specific supply issue?
Well, this is entirely outsourced. We don't make any of the culinary products ourselves. These are the vegetable paste, fruit paste, and coconut water. Sorry, not coconut water, coconut milk and powder. All these are outsourced, and some of our co-packers, they had working capital issues consequent to GST, other issues. So we were very reliant upon them, and it was entirely a supply side problem. There was no inherent issue in terms of demand.
So my second question is on the toothpaste business. You have grown 26%, 2 year CAGR of 10%, which is still a very good growth. Now you and Patanjali are essentially in the naturals. Now competition scenario is changing with Ayush, which they have called out that in toothpaste it seems to have started off well. And even Ved Shakti of Colgate has gained around 100 bps market share. So do you need to respond to these, and would you say that the worst of Patanjali in this and in some of the other segments where you compete against Patanjali, worst seems to be behind?
I don't think there was much of a Patanjali impact on our oral care business. We consistently grew the Red and the Miswak franchise, 20%, 25%. Babool was a bit of a laggard, but then Babool also has staged a sharp recovery over the last 2 quarters. So I don't think that was very material. It was very material in honey, and I think we have recovered almost entirely the lost ground by just giving a better product at a sensible price. So the 33% growth in honey, 40% if you exclude the canteen stores, is a very visible sign of that recovery. And this is 2 quarters in a row of growth. So I hope the trajectory will continue. So I think the competition effects have been, I won't say entirely eliminated, but substantially mitigated.
And any comment on Ayush and Ved Shakti? Would you need to respond, or do you think your product is differentiated?
I think we have got very strong products with very strong growth paths. Having said that, we need to do a little bit more in this category, and you will see that happening very early in the next year.
And so last question from my side. So in household insecticides, we have seen the market leader also struggle for the last 4-5 quarters. You also called that out. So I have 2 questions here. One is why earlier it was thought that consumer has made this as a habit. Now suddenly every company is pointing towards seasonality. Second is, of course, in terms of the out-of-home, has the category expanded with Godrej coming in there, and you have also come out with a roll-on. So how do you see this category? Currently it's quite small, but where do you see this from a longer term?
Well, insect repellents, mosquito repellents are not really a habit. I think that's wrong to say so. When you have mosquitoes visible in the air and they start biting, you start using these products. And when there's an epidemic, you start using them even more so. But when there is no such thing, like in winters in North India, then you stop using them. And that's a behavior which nobody can change. So when there is such a situation happening, then you will have high usage. Well, fortunately, there wasn't much evidence of any epidemics, dengue, etc. in the northern part of this country, even the south. So the overall insecticide table came down, and I think the result of Godrej reflected the same situation as what we are in. And coming back to your personal application category, it's highly underpenetrated. I think total category size will be around 100 crores, which is ridiculously small, given the sheer size of the problem. So, in a sense, having somebody else come in would serve to enhance perception and increase market size. So, we would welcome that. I think it requires more than just one player to grow this market.
Okay, sir. That's quite useful. Thank you.
Thank you.
Thank you. Our next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir. This is Percy here. Sir, on 10th November, there was an announcement of GST rate cut in some of the categories, and it was applicable from 15th. Most FMCG companies obviously cannot change the dates, prices, etc. within a period of 5 days. So most companies have staggered the price changes over the next 15-20 days. Now the market leader has said that they have parked in escrow a certain amount which they gained in that changeover period and doesn't belong to them. So what have you done in terms of passing on the benefits of that sort of lower rate to the consumer in that 15-20 day period it would have taken for you to change the pricing, etc.?
Yeah, what we did is we with immediately effect, we reduced the prices to the stockists, right? That we did without any pause. Obviously, there would be some stocks where the older price would exist, but we have written adequate amount of communication to our stockists as well as heavily advertised in the newspapers, informing them of the price change and requesting them to pay only the lower price. And then the changeover which we did also happened very rapidly. So I don't think we have any exposure at all. Our books are open, anybody can have a look, and I think we have taken whatever action which was required to deal with this whole anti-profiteering issue.
Okay, so you're saying that basically for the short period of time that MRPs could not be changed, the difference was passed on to the distributors as additional discount sort of?
And communicated to the consumer.
Okay, understood.
That's why we did discuss this issue. We don't believe there is any need to provision any amount towards any eventuality. Our books are very open to anybody who wants to scrutinize them.
Understood. So, just wanted to, in that context, understand your gross margin expansion. I mean, YOY it's expanded very significantly, and even QOQ there is a decent expansion. So, what has driven this expansion when generally crude and such inputs are moving up, and you also haven't, I think, taken any significant price increases?
Well, let's take standalone material cost change, which is 360 bips, right? Out of which 70, correct me if I'm wrong, Lalit, 70 is entirely on account of the GST related issues, which are not really material, because then your numerator comes down,
Yeah.
your margins improve. Denominator comes down and your margins improve. So out of the balance 290, 150 basis points on account of reduction in CP, right? And the balance
is because from the last year there has been 2.4% price increase, so 50% of that roughly 1.2 is the effect.
So the balance is a mix of price increase and material deflation. And Q3 we are still sitting on a small level of deflationary costs. So it's really on account of that, and perhaps a little bit on account of mix. Mix because juice has come down, low margin. HPC has gone up, high margin. So it's a lot of moving parts here.
Okay. So is this the quarter, I mean Q3FY18 is the quarter in which your promotions have gone down materially, or it's gone down in 2Q itself and just on a YOY basis Q3 has gone down? Or is it gone down even sequentially?
No, progressive. Once we did massive promotions in Q3 which spilled over into Q4 of last year. We realized that that's not really the way to go. GST also made consumer promotions less attractive because you have to pay full tax on them and not get any credit. So net, it made sense to kill consumer promotions and to increase ATL. So ATL spends have gone up at 31%, and CPs and TPs have gone down by a similar amount. So we are rebalancing the entire A&P portfolio. What is visible to you is advertisement and publicity, which has gone up very substantially.
So basically you're saying these margins are sort of more or less sustainable. It's not as if it's just a flash in the pan.
Inflation remaining the same, yes, but we have every reason to assume that inflation is going to pick up starting in the fourth quarter, particularly on account of petroleum derivatives. We're seeing sharp increases in LLP. Coconut oil is already on fire. So both coconut oil is of course the outlier, bigger gradient product, which is very, very inflationary. But all the oil derivatives are now kicking in with higher costs. So we'll have to deal with that. I think we'll see a minor uptick in inflation in Q4 and then perhaps more substantive in the quarters ahead.
Okay. And my last question is on demand. So this quarter numbers are fairly good, but if I look at your 2-year CAGR for most of the categories, it's low to mid single digit sales growth. Of course, there are a couple of exceptions like home care and toothpaste is also almost 10%, but otherwise mostly it's low to mid single digit CAGR. So just in view of that underlying demand situation, your growth aspirations of a high single-digit volume growth would mean that the underlying demand needs to improve from the current levels quite materially. So how confident are you of sort of achieving...
That's one way to look at it. The other way is that you just improve market share. So even if an environment which is not supportive of growth, which is the situation today to be very honest, we can still show good growth even on a normal base on the back of market share gains. So the reality of the situation is that there's been a sharp trending down of FMCG growth rates. Just to give you a data point, that the growth rates peaked in Q1 in terms of volume at 13.9%. Of course, this 13.9% figure we should take with a pinch of salt. It is obviously much lower than that. But subsequently, they've trended down to 8.5 in Q2 and 5.7 in Q3. Now, these are hard numbers in terms of FMCG. Our categories in which we operate are similar. And I think that is something which is causing us concern. We do hope that consequent to tomorrow's budget, there would be a sharp reversal of this downward trend because this is really a part of the whole rural distress, agrarian stress, etc., etc. And we will be able to ride a much higher level of secular growth. And then coupled with the market share gains, we should definitely be able to get to that high single-digit volume trajectory. Not to be taken as a given, but every reason to expect that it can happen.
Sir, so what will drive this market share expansion?
Better execution largely. What we have done is consequent to, and I've mentioned this in my last con call, this project Bunyad which we had, which meant we deploy a substantially higher number of people on ground in rural areas by dividing the portfolio down the middle into the two components of HPC and HC. Foods is not really material in rural. Has given a big fillip to our rural growth. Rural growth this quarter were 23 points ahead of 23% in a pretty stressed rural environment. So it's really execution and market share gains, which that's the only thing we can depend upon. We cannot depend upon category growth reviving. If we keep using that as a sort of excuse to justify low growth, that's not going to work. So we have to outperform.
Right, sir. Thanks and all the best.
You're welcome.
Thank you. Our next question is from the line of Amit Sinha from Macquarie. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, my first question is on the oral care business, and despite a significant step up from some of the large competition in the naturals and the Ayurvedic space, your growth has remained pretty strong. Just wanted to understand from you that how much of this market share gain has been on account of your execution and some of the distribution steps which you have taken, and how much of that is coming on account of the Ayurvedic natural trend which is emerging in the country. Yeah.
Well, hard to say how much. It's obviously coming from both. We are gaining share in the aggregate sense. And of course, the natural space is growing ahead of the non-natural one. The competitors other than Patanjali are still very, very small, so I don't think they've really moved the needle in terms of growth for us. And I think the Patanjali effect, which was perhaps at its peak around a year ago, is now ebbing a bit. He still is doing well in toothpaste, I'm not denying that, but we are now getting back whatever losses we had in some of the markets like UP, where he had gained some share at our expense. We are getting the share back very rapidly.
Okay, and there has been absolutely no impact on account of the big launches from some of the other players.
Well, they aggregate to 0.5%, 1% in terms of market share. So I don't think that's a very material level where it can upset our growth rates. It's only Patanjali which grew from 0 to something like 7-8% literally in a matter of few quarters. That could have had an impact. I think our growth would have been even higher if he had not been here. But having said that, he has further, in a sense, expanded the whole herbal base, and we can take advantage of it. So whether it's in honey and whether it's in toothpaste or in personal applicator insecticides, often the advent of competition is very positive for market expansion and growth. And we've seen every evidence of that. Patanjali did help us to expand the natural space to much beyond what it was originally envisaged.
Sure. So if just wanted your commentary in the longer term, let's say for the next 5 to 10 years. I mean, where do you see the naturals Ayurvedic space in the oral care category to be in the overall scheme of things?
Well, it's hard to guess, and I think we keep pushing the numbers northwards. Now, I would say that let's say by 2022, the natural space could be as high as 40 to 50%. 5 years from now, 2023. So I wouldn't have said that even a year ago, but definitely the preference for natural products is very strong, almost unstoppable, and there's no counter from the folks who are manufacturing the regular products, because they can counter it by having high-priced specialist products like sensitive, etc., etc. But those are beyond the reach of vast majority of people.
Sure, sir. My second question is on the hair oil category, and if I do a 2-year CAGR, then third quarter FY17 was exceptionally bad for you, the entire hair care. So
yes.
Just wanted your commentary on how do you look at these numbers. Is it still weak? And you have specifically mentioned about strong coconut oil performance. So what is the price hike taken there, and how much of the growth is because of volume?
Well, it's almost entirely volume growth, except for coconut, of course, where there's been some price increases. But it's been driven really by LUPs. So I think our volume share growth has been very substantial. And going forward, I think our volume shares will continue to grow, definitely grow ahead, ahead of anybody else. The challenge will be to continue to maintain or increase the value share, and that's going to be harder. Let's put it this way: the volume share growth. I think we have now got our act together in terms of both distribution. This project Bunyad was very instrumental in pushing our low-price hair oils into the deepest interiors, and that process will continue. But yes, there would be pressure on the top line in terms of overall peak growth.
Okay, sir. That's it from my side. Thank you very much.
Thank you. Our next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Firstly, on the international business, so two parts to it. One is from going ahead, how much does the difference between the constant currency and the reported growth narrow down, given your basket of currencies in your view from the fourth quarter onwards, based on whatever is the current situation? And secondly, what is the issue in Namaste because of which there's again a big negative dip on the CC? And how do you see that situation evolve over the next few quarters?
Yeah. Well, to answer your first question, we had around a 90 crore translation loss in Q1, am I right? Yeah. 90 crores. Similar in Q2. Yes. Q3, this quarter, which we are talking to, is 66. Next quarter, we anticipate it to be 25. Okay, so that gives you the trajectory. After the next quarter, I can't really hazard a guess because there could be shifts which I can't envisage. So therefore, the currency, and a lot of this 25 crores next quarter is going to be actually on the rupee strength rather than on the downstream currency weakness. So the rupee versus, we're going to have, out of this 24 crores, around half is going to be from, let's say, the Turkish lira to the dollar, and half of it is going to be dollar to rupee, assuming that the rupee continues to remain at current levels. So the overhang of currency is going to be substantially, if not entirely, eliminated by the fourth quarter. So that's one big monkey off our back, because this was hurting the top line of international. And the second big positive is Saudi Arabia, which again was literally on oxygen last couple of years. We have done major changes in Saudi Arabia, recovered growth substantially, grew by 30+% this quarter. And we hope that strong growth will continue in Saudi Arabia. So that's one big reversal. There have been some setbacks too. Algeria, Lebanon, Libya, and Yemen. These three countries, which cumulatively account for around 50 crores a quarter, they have been, 30 crores a quarter. They have been almost reduced to zero levels because of internal strife or other issues. But having said that, we do believe Algeria and Yemen would come back, not to normal, but to better than earlier performance in the fourth quarter. And then let's see going forward, how does it look. Sub-Saharan Africa, both for Namaste and Dabur, is doing extremely well. So we're growing around 25% in dollar terms, so that's a very big plus. Egypt is doing spectacularly well in their own currency, but up to this third quarter, we lost most of it in translation. So Egypt grew by 46% in Egyptian pounds, but minus 5% in INR. Now, with the Egyptian, and that's a big market for us. So with the Egyptian pound normalizing, we should see very strong growth in INR from Egypt coming in Q4. Namaste remains an overhang, but the pace of deceleration of the business has now come to a halt, and I think we would be plateauing out at almost zero growth levels in Q4. So that's why, while that may not be a greatest of situations, I think the pain of Namaste would now come to an end, and we would now see how sharp the reversal of that business can be in the year ahead. And I'm not saying it's going to be easy, because North America will continue to remain stressed. But we are seeing, like I said, very good growth in Sub-Saharan Africa, which should take away some of the pain on North America. So that remains the only issue. The other issue which we are facing is currency in Turkey, which again is the only currency which is not really restabilized, which is continuing to weaken, and that's going to be a little bit of a headwind from Turkey. But overall, if you put all the pieces together, you will see substantially improved performance from the overseas business in Q4, and we hope that will continue in the quarters ahead.
Sure, sir. And on, so while, clearly the top line will recover, what is the outlook on margins there? Because they will obviously be input cost pressure.
The margins will mirror the top line. Because, one of the issues with regard to currency depreciations is your gross margins come down because you import a lot into the country and the importation cost is high. You can't pass it on to the local market in entirety, so your margins shrink. So our margins in Egypt shrank by 10% or more than 10%, and I think we should be able to recover most of them now with the currency stabilizing. So the bottom line also would look good. I don't have a clear visibility about what the trajectory is, but the first cut numbers do show that international profitability will be again a strong growth on a YOY basis starting from this quarter.
Sure. And one bookkeeping question on, the reason why I just wanted to understand the other income dropped this quarter and how should we look at that going ahead?
Yeah, Ashok will answer that.
Yeah, the main reason for that in the base quarter there were certain capital gains due to some sale in the base quarter which had not happened in the current quarter.
Okay, but this quarter there's no one-off, so this is
interest rates have lowered the yield, so
there is one-time profit gain on account of sale of investments to the tune of 16 crores. That made the difference, and also the interest cost is coming up, which has an impact on the yield.
And there's some mark-to-market losses on account of the no, not here. Okay. So this pain will remain as long as the interest rates continue to harden. We would see lower growth in non-operating income.
Okay. Thanks, sir. That's it from my side. And all the best.
Thank you. Our next question is from the line of Vicky Punjabi from JM Financials. Please go ahead.
Hi, good evening, everyone. This is Richard here. Mr. Mukul, you've partly dealt with this in the previous question, but I just wanted to get your broader high-level thoughts, on the topic of international business. A few years back, of course, a lot of the Indian companies went overseas with, I guess, the objective of these regions providing a delta to the overall growth profile versus the India rate of growth. But, if you see the last few years, they actually proved to be decretive and extremely volatile. There are, of course, a lot of valid reasons to this and, which you just mentioned to the previous, question. But in light of all these, how do you now look at international investments? The short question is that, are you as structurally bullish about going international as you would have been some years back?
Yeah, I think, Richard, what we thought we would get is, immediate gains from acquisitions, and that obviously has not happened. But having said that, the long-term strategic reasons for doing these acquisitions, Namaste really to build a franchise in Sub-Saharan Africa more than anything else, they remain intact. And I think without Namaste happening, we could not have built any substantial presence in South Africa. I mean, if we didn't do Namaste, we would have to do something else. But we couldn't have done it on its own. The black consumer is very different from what we are used to, and we don't have the knowledge to deal with the consumer. Now we do. So if you take a 10-year perspective, I think these are good deals. If you take a short-term perspective, they do look a little bit toxic. But while I think I don't regret these acquisitions, obviously with the benefit of hindsight, we would have executed them a little bit differently than what we did. But I think if you take the long term, we will definitely benefit from them. Sub-Saharan Africa is a big prize, and Namaste is a perfect entry point into that market.
So if you do see, if you are given an opportunity for another, international buyout, you will continue, to evaluate those? Despite the kind of...
We certainly would. No, but having said that, we have gained a huge amount of experience. Remember, these were our first two acquisitions outside India. So there was a learning curve which we had to go through, and now having been through that, we are far more prepared to see the underlying risks and to deal with them and to take preemptive action to deal with them. For example, in Namaste, we did see this huge natural waste coming. So we didn't map it out properly. We weren't used to that ecosystem, and we weren't used to that pace of change. So we won't be caught napping, I think, this time. We'll do our diligence in a far more structured manner, and I think after having gone through this learning process, some of which has been painful, it would be foolish just to disregard it. But like I said, we'll be much better prepared.
So if you look, let's say over the medium term and, let's say 3 to 5 years out, in your own, business plan that you're drawing up, do you still envisage a situation where your current basket of international businesses, do you think that basket is going to grow faster than, than your Indian business?
Well, last 4 years grown slower. In fact, this year on a YOY basis, our international business has shrunk to 27%, down from 30% a year ago. So it's really the Indian business which is moving the whole needle.
No, I'm saying that, what's your expectation for the next, now that...
Honestly, I don't know. I mean, we deal with the international growth on a case-by-case basis. We pursue deals which we believe are good. We walk away which we don't think so. So far after Namaste, we haven't done any acquisitions, even though we have been looking all the time. So it's very hard to put a number to it. I mean, I still think that the current trajectory, between 3/4 and 2/3 India and 1/4 to 1/3 international is probably the band which we'll operate, but this could change.
Okay. And one more question, if I may, on foods margin. If a lot of the festive packs got advanced to Q2, and I guess these packs are relatively lower margin products, what's the reason for foods margin of Q3 being lower compared to the level seen in Q2?
No, I think the gift packs don't have any material impact on margins. The net margins are similar, a couple of points here and there.
Mainly because of CP.
The CP, right? We did give massive CPs in the base quarter.
Yeah.
If you remember that. Yeah, that's one. So the CPs we have taken off the table, and that has partly led to this vastly improved margins. We also made network changes. We've got rid of a lot of third-party co-packers and moved that production in-house in Pantnagar. And that has also been better in terms of
area-based exemptions.
And we got some area-based exemptions in Pantnagar. So the margins have expanded, and the strong rupee has helped because a lot of concentrates are imported. So we get them at a lower price because of the strength of the rupee. So that's the real reason.
Okay, no, I was actually talking about the 15% clocked in, in Q2 of FY18, which has come down to 13% in Q3 of FY18. I'm just talking about a quarter on quarter.
Yeah, actually it's a product mix also, because the 200 ml has a lower margin versus 1 liter. So what you see is that we have more 200 ml this quarter versus what we had in the Diwali gift pack earlier. So that is one of the reasons on the mix side.
No, I think that 2% is not very meaningful.
Yeah.
I mean, I think one should look at it in the context of YOY, where I think 8 has moved to 13.
Correct.
That is really the big change. A couple of percentage would be just a small mix issue, or maybe, and part of it, yes, you're right on the Diwali gift pack, but like I said, it's not a big number.
Okay, got it. Thank you very much, Mr. Dugal.
You're welcome.
Thank you. Our next question is from the line of Vivek Maheshwari from CLSA. Please go ahead.
Hi, good evening, everyone. My first question, sir, is on the margins. So you mentioned something, in case if let's say crude and all the crude derivatives remain where these are right now, you mentioned you will be able to maintain margins. Is my understanding correct?
Yeah, I mean, I think in Q4 we should be able to, because the inflation, we are still sitting on a substantial amount of low price inventories which we'll be consuming, and our margins are on consumption, as you know. Now, going forward, once this whole anti-profiteering overhang and all is over, we will take up prices in line with the inflation numbers, and that would happen early in Q1 of next year. We haven't really done that mapping in terms of our price increases, but Q4 will be fairly subdued. Q1, I think, if inflation continues the way it is, oil prices remain at this level, coconut oil prices again remain at this historically high levels, then we'll take up prices.
So basically, if I understand you correctly, where the spot prices are in general, you need a price hike to basically manage margins, right?
Yeah, I mean, where the increases, input cost increases are in strong double digits, we need a price increase. There's no other way we can maintain the margin profile.
Okay. And this anti-profiteering issue, what you mentioned by, let's say, one is I'm not very clear. So, I heard you on CNBC also a while back, and you mentioned about, you are not very clear how do you take up prices, what authorities will look for. Do you need to, have a product price list, or basically the calculation around how much is the inflation, etc. Is there any concern on that, or by first quarter you think that concern will be behind?
I think that concern will disappear in the first quarter. At this point in time, since it's a very live issue, it's better to be on the side of safety and not take up prices even if the input costs are hurting, which, like I said, will not be doing so meaningfully this quarter, but perhaps for the end of this quarter they will. But we can postpone it by a few weeks just to not cause any issues with the regulators.
Okay, sure.
But whatever we do, there'll be, since anti-profiteering is not going to disappear, we'll have to justify those increases with the detailed calculations in terms of and the rationale behind those price increases. So we'll take that also into cognizance. So proactive price increases, I think, for the next few quarters may not be that easy to get.
Okay. Are there rules which are formalized on this issue? Because, I mean, the way in which crude, let's say, and if that is only one variable, if we take the way in which crude prices have moved up, I mean, let's say in a market like India, you should be allowed to take up prices, right? There should be no concern as long as, and once you've passed on the GST impact, it's up to the industry or the company to take up prices, right?
Absolutely. I think, see, the fact remains is the anti-profiteering only says that when the rates were reduced from 28 to 18, the benefit was to be passed on to consumer. But it doesn't prohibit or stop any company in terms of increasing their price if the input cost is going high. So that is very clear. The only question is that if there is a rate reduction, have we adequately passed it on? And that's what Mr. Dugal was stating, is that we have taken adequate steps to ensure that we have passed on all the benefit that we got to the consumer, and therefore there is no impact. And while going forward, if there is any inflationary pressure that will come, that will be evaluated in terms of increasing the price, but that probably will happen in the first quarter because we are sitting on some inventory which is at the low.
Whatever the situation, even in the first quarter, we'll have to build a detailed rationale and a case for price increases by having visibility over our value chain, so that there's no disconnect. But we'll see how the anti-profiteering issues shape up. At the moment, there's not too much other than a couple of notices here and there.
Okay. And sorry, if I may just one follow up on this. When you say you have to have a case, basically that's for your internal working, or you have to, every time that you take up prices you have to.
Well, let's put it this way. If I do any price increase in this quarter, I will first make sure that there is a detailed rationale to support the price increase so that I don't fall afoul of the regulators. Now, going forward, obviously, this is not going to continue forever. We are in a free market. But we have to manage the sensitivities which are there. And I'm sure they won't last for long. Perhaps by the end of this quarter, anti-profiteering would become redundant because other aspects of the value chain would then begin to factor the margins.
Okay, got it. Second, quick comments on wholesale and CSD for this quarter. Like you mentioned last quarter, what was the growth in both these or degrowth in both these channels, please?
Well, the CSD it declined by 22.5%, which was a big drag.
Sorry, how much, sir?
22.5% was the decline in canteen.
CSD channel.
Right. Okay, let me give you a breakup in terms of various channels because this is interesting. The distributors, what you call GT distributors, general trade distributors, grew by 13.7%. Right? This is distributors whom we sell in urban centers and then who sell to retail and to local wholesale.
Sure.
Super stockists, which is really the rural wholesale, grew by 26%. Right? Modern trade grew by 17.6%. So not spectacular, but above the stockist growth. Cash and carry, which is modern wholesale, grew by 16.6%. Food services, which is enterprise, grew by 73%, but then this is not a big, it's only 1% saliency. Paramilitary, again 1.4% saliency, grew by 27%. Other institutions grew by 12.2%. And canteen, which is the big daddy in terms of enterprise, the B2B business, declined by 22.5%. So all this growth you see are net of CST, and CST is very material in Chyawanprash, in Amla hair oil, honey, and Chyawanprash. So these three is very big. Oral, I'm not too sure it's that big. Well, for salience there is, but the big three are Chyawanprash, Amla hair oil, and honey. So the growth that you see, which are already good, are despite this overhang of CST.
Okay,
and of course, CST impacts everything, including juices, where it's got a 2-3% saliency, and oral care everywhere. So I think we managed the CST deceleration quite well by tapping into other channels, particularly the rural wholesale, which 26% is a very high growth.
Sure. And thanks for all these numbers. All these numbers are, I presume, like for like, adjusting for GST in the base as well?
Adjusted for GST.
Yeah, they are all adjusted for GST. Everything which we hear now will be adjusted for GST.
Okay, got it. And last bit on Chyawanprash, how did Chyawanprash do in this quarter? If you adjust for CSD.
12.2% overall, and net of CST it was 20%.
20%. So again, but 12.2 if you include CST. This is again adjusting for GST, right?
Yes.
So again, it was a great growth, despite the fact that the winter has been fairly subdued in the north. So we are pretty happy with the way Chyawanprash has performed. We did not really pump in too much money behind the flavors and the variants, because we felt that we should wait for another year once the market has totally normalized and our own financials are back on track to really then input into it. So next year we'll have a massive program of investment behind the Chyawanprash franchise, which we did not this year.
Okay, all right, perfect. Thank you and wish you all the best.
Thank you.
Thank you. Our next question is from the line of Aditya Gupta from Goldman Sachs. Please go ahead.
Hi, good evening. A couple of questions. One on oral care. So you mentioned that the growth is driven by increasing penetration, maybe channel-wise or geography. So can you just some more light on how much more scope for this penetration-led growth is remaining? How much ground you've covered already?
Well, it depends upon the rate of conversion now. I think the penetration in terms of geographies, while still a lot of headroom still exists, but that won't continue forever. So it is really going to be a conversion game. How much can we convert from the regular non-herbal toothpaste into toothpaste? And everybody's playing the same game. The recruitment is from the regular products. Now, who does this conversion best will be gaining the most. I don't think the toothpaste category is growing at more than the high single digits. So the herbal, if they're going at 20-30%, I don't know what the Patanjali growths are, but the multinationals, of course, on a zero base, they've also done some growth. So the slice of the pie is increasing. But in our case, we do the recruitment from our competitors. In the case of the multinationals, they probably will have to do recruitment from their own franchise.
Got it. And second, just on, you mentioned that e-way bill is going to impact demand in the near term. So, there are limited details, I guess, but do you expect this impact to be a month or longer than that? And will it be homogeneous across your categories, or would some categories be more impacted?
See, 14 states have implemented the e-way bill from tomorrow. The big one is UP, of course, and then most of the southern states have done it. I think all the 4 southern states are implementing it. Then there are a couple of smaller states in the northeast, etc. But the material one is UP for us. And I don't know. It could be disruptive because it is very restrictive. Any movement above 10 kilometers and any consignment size of more than 50,000 rupees has to be supported by e-way bill. Now, while the process is reasonably simple, but even doing that, given experience with GST, will definitely be a challenge. So this has come as a bit of a surprise. We were fully prepared for intrastate e-way bills because that is really entirely in our own hands. We ship from factory to the CNFAs, which are controlled by us. So no issue there. But then suddenly, 2-3 days ago, this intrastate, which we were expecting from June, came, and there's a little bit of concern about its impact in terms of day-to-day movements. Even let's say within a city like Lucknow, moving a shipment from point A to point B, if it's more than 10 kilometers, has to have a e-way bill. So it's pretty complex, and there's so many issues with regard to this e-way bill that if I am sending a delivery van having say 25 cases, which is 50,000 rupees, from my stockist to maybe 30, 40 retailers, what form does the e-way bill take? Because the e-way bill has to specify a certain consignor and a consignee, and if there are 30, 40 consignees, what do you do? So it's another issue which again I think we'll navigate it. How long it'll take, I don't know, but there is some concern here.
Thank you. That was very helpful. Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, you may press star and 1. Our next question is from the line of Manoj Bansal from Ambit Capital. Please go ahead. Mr. Manoj Bansal, could you unmute your line and go ahead with your question?
Yeah, hi. I just had a question around the OTC pharma range.
Yeah.
So the growth seems to be relatively muted as compared to most other categories. So anything specific about this category which could have led to the lower growth? And secondly, there has been a big product launch which has been in the works for a few years around this whole range, where products around diabetes, cholesterol, blood pressure, arthritis, etc. have been under development. So any updates on when can we expect a larger launch in this product range?
To answer your second question first, around 10 products under the ethical range have already been launched. You may not have seen them because they've been launched through the prescriptive route. So there are products for liver, for stress, for arthritis, for a laundry list of ailments. Very good products, very safe and efficacious. But we still feel it is prudent to incubate them through the prescriptive space for a couple of years before we take them OTC. That's why they're not very visible. But if you want to see some of those, you can go on our website, or Gagan will give you some more information about them. So these are some very exciting and very promising products which we will take to market through media whenever we feel it is right. At the moment, we are still scaling up our prescription infrastructure. We've got a new team on board to deal with it, and we would look at a highly accelerated pace of supporting this whole detailing framework in the current year. In the next
so, sir, has this launch gone national now? Because I believe you had been test marketing them in a couple of states. Is the prescriptive route and the launch
no, it's still regional, it's still regional. And what we are doing is we are putting different products in different regions. Because through the prescriptive route, there's a limitation in the number of products you can take to the practitioner. It's typically 4 or 5. So we are doing something in some states, something in the other, and then we'll see which ones are most suited to take to market when. And there'll be a lot of learnings from this whole exercise. But the whole ethical piece is going apace. There's a lot of attention and disproportionate attention on the part of the management towards this particular initiative. And we are pretty happy with the way it's performing.
Right, sir. And on the overall growth rate for the category, anything specific about this category which has
very hard to say. Very hard to say, but I think the growth rates would definitely be in the double digits from next year onwards.
Okay, all right, sir. Thank you. That's it from me.
Thank you.
Thank you. Our next question is from the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi, good evening. Just had two questions on the international part. Firstly, just on margins. Both the acquired businesses, Hobby and Namaste, have over the years seen a shrinkage in margin, and probably towards the end of last year, margins were at all-time lows at the EBITDA level. Just wanted to get your sense now that you are looking hopeful that these businesses are going to stabilize and grow going forward. What's the specific outlook on improving margins here?
Well, I think the Namaste margins are already showing signs of improvement, and we will rapidly scale up the margin delivery from here. The challenge is more on the top line rather than on margins, because we have cut costs now tremendously over the last couple of years to support the smaller business size. And the Sub-Saharan Africa would support margin growth also substantially. The challenge is more with Turkey in terms of margins, because the currency issues still remain relevant there. And this is the only currency which is continuing to show signs of weakness in our entire basket. So the moment currency stabilizes, our margins will improve. There's no doubt about that. But it's very difficult to improve margins with a depreciating currency. The price increases which you take can never compensate for the margin erosion on account of the weak currency.
Okay. My second question on the international front was, a large part of this international business has been developed organically over the last few years.
Yes.
Just wanted to get your sense on whether you see cross-pollination opportunities from some of these successful international launches to India, and is there an opportunity there sitting possibly in the future, next 1-2 years, that you can think of, or something you're thinking of going forward?
Yeah, definitely. I think from the Dubai franchise, there's definitely a lot of cross-pollination can happen in India. And we will begin to do that with hair care products like high-end hair care products like serums, etc. Now that e-com offers us a window to go to consumer without the whole issues with regard to trade, that's probably a good platform, and it will become increasingly powerful as the years go by to introduce new products without the issues which you have to deal with in selling through the traditional trade. So the cross-pollination will happen between Namaste and Dabur. Quite frankly, there's very little, because that is for black people, and so it's not really relevant to the Indian consumer. But the cross-pollination of Namaste is really happening in Africa from the US, and that's really the reason, like I said earlier, we bought this business. How do we populate Africa with Namaste products, and have the whole learnings from the Namaste business to leverage the Africa opportunity?
Okay. My last question was on India and on really the underlying rural-urban trends. I know you have touched on the fact that rural growth for you was quite strong, but that was really led by your internal initiatives.
Yes.
Just wanted to get your sense on the environment that has tracked in rural over the last maybe 2 or 3 quarters, as well as urban, and the thoughts going forward.
Yeah, like I said, the growth, a lot of the growth which you've seen across companies are really a base issue, and going forward, stimulus could lift the whole growth trajectory into a different orbit, or it could not, depending upon what the budget, etc., presents. So I think we really have to be prepared to slug it out in terms of better infrastructure, better execution, and therefore share gains to drive growth. I still think that double-digit growth in rural markets, even in a very slow burn environment, is eminently possible for us. We do believe we have world-class infrastructure which we've built over the last 1 year or so in rural India in particular, to deal with the challenges of low growth.
Got it. Very helpful. Thank you and all the best.
Thanks.
The next question is from the line of Nilay Shah from Morgan Stanley. Please go ahead.
Thank you. Just 2 questions for me, sir. Could you comment on the recent management changes at the mid-managerial level between India and the international business, and what triggered that?
Well, I think we are building up for the next year in terms of succession planning, and we have a strong desire to do it from internal resources rather than to recruit from outside. So this is part of a cross-pollination process that you move people around, give them exposure to different geographies, challenge them in a different operating environment, and that would reveal the qualities which we require for orderly succession from within. So it's part of a very carefully crafted process which would have happened a couple of years ago, but then this whole issue with regard to demonetization, etc., put this process back by 2 years. But now we are back in the game as far as business is concerned. It's the right time to hand over different businesses to different people. I would have not liked to do it when we were in a crisis situation, which was there 2 years ago up to now. But since the business has now stabilized, this is the right time to make the move. And we'll progress it in a manner which we are comfortable with, at a pace which we are comfortable with. We have outside help also from a leading HR company. So I think it's been very well crafted, and we believe that it would lead to orderly succession in the years to come.
Got it. And just taking off from the earlier question on cross-pollination, you had started the process with the baby care portfolio, but it seems to have got lost somewhere. Is it just an issue of timing, or you've changed your views on that?
I think it's an issue of prioritization. When we baby care was really going to be piloted in the MENA region, particularly in GCC. That was where we would have got the learnings to transplant to India. The India initiative was really around a baby oil, which is different from lal tel, which everybody may not like to use. But we did pilot the baby care initiative 2 years ago in the Gulf. But then the Gulf business fell apart, with all these the issues with regard to the MENA economy. And baby care was the first casualty of that. So we withdrew it, like we withdrew some other products also, and we shrunk the business a little bit to its core. Now with the MENA rebalancing, we are really looking at baby care once again with some level of seriousness. So when we make the brand plans for next year, we will definitely have baby care as an initiative. How much will we progress it, I don't know. And that's another example of cross-pollination. If we get it right in the Middle East, we can transplant the learnings into India and have a baby care business here. But it's a very tough category to enter, we may choose not to enter it, because if our focus is shifting towards healthcare for adults in terms of lifestyle management, lifestyle disease management, we may put more of our resources there. We can't spread ourselves too thin.
Okay. And last question, in terms of the next 2 or 3 years for the India business, where do you expect the max acceleration in top-line growth to come from? Which categories, broadly speaking? Without getting into the brands also, it's okay, but just which category? I know toothpaste is one of them for sure, but what else apart from toothpaste?
See, most of the growth may continue to come from HPC and foods. But in terms of long-term strategic rebalance of the portfolio, the move is towards healthcare. So healthcare may not be significantly impacting the mix or margins or profit over the next, say 2, 3, 4 years, but it is a long-term strategic imperative. Now, many of these initiatives are slow burn, so we've got to be looking at a horizon which is 5 to 10 years rather than 3 to 4. So I do believe that while healthcare may, sorry,
for the first time hearing you talk about market share gains. So you obviously have your plans drawn up in terms of which categories you're going to target. Healthcare, you have in the past said it is slow burn, so that's impossible that can, drive that near-term high single-digit growth that you're looking for. So which other category are you really gunning for? You've done very well in toothpaste, but apart from that, what else?
We look at share gains in all the key HPC categories, and then we look at share gains in healthcare categories like Chyawanprash and honey. And then, we look at sizing up the whole space in, say, digestives, for example, where we have strong brands, but comparatively small. Now, we're not looking at market share there because that's not a relevant metric. But in let's say, digestives and cough, cold, we would be looking at, very, very high levels of growth and high levels of investment. So we're going to pressure investments, give disproportionate investments to a few brands, and I don't know what they are because that will emerge over the next few weeks. But these are 3, 4 brands which are currently perhaps in the 30 to 50 crore segment, but very scalable and which enjoy inherently high margins. And then we'll be putting in substantial amount of resources, disproportionate resources. We may lose some money for a year or two, but I think if we are able to scale them up, then the fruits of that investment will be very high. But definitely the way to grow, assuming that the category growth remains subdued, and that's what the situation today is. The only way to grow in the big HPC categories is through market share gains.
So what you're saying is in the big HPC categories, the precise plans for which categories, which brands will be drawn up only in the near future?
Well, a couple of weeks from now, that's when the brand plans will be crafted. It's already being worked on. Now, we just have to see it at the senior management level. And then prioritize as to what brand gets what investment. Obviously, we can't afford investment across the whole portfolio, so some will get high level of nourishment, some won't. And that's really the trick in picking the right horses which can take you to that desired level of growth.
Got that. Very clear. All the best.
Thanks.
Thank you. Our next question is from the line of Anubhav Sahu from Antique Research. Please go ahead.
Hi, sir. I wanted to understand from you, is there any regional differentiation in rural growth you're picking up, or is it too early to call a trend?
Sorry, I didn't get that exactly. What did you say?
Any regional differentiation in rural growth? This quarter it has been good, but is there any regional pattern?
I don't know whether it's it's structural or whether we can extrapolate it, but let's say this quarter and maybe the early quarter before this, we got very good growth from east and south, and comparatively low growth from north and the west. But like I said, you can't read too much into it. These things keep changing.
Right. And so, by any chance, would you have the last year's numbers for distribution sales growth mix? Same year.
Yeah, we have some numbers in terms of the direct reach, distribution reach, which has gone up around 10% in the last quarter, 7-8%. Sorry, there is
9 million.
It's now exceeded 1 million, which was a big milestone. And the growth really in terms of reach has come from urban. Once again, let me clarify that this whole rural outreach program is not to expand distribution width. We believe we have adequate. It is basically to get more SKUs into the whole distribution funnel, and that's why we divided the sales organization down the middle. So we now have 1.02 million outlets and touch points. We had 941 3 months ago, so that's a big increase. And most of this increase has come from urban actually. The rural is more in terms of quality of distribution rather than in terms of numbers. I think in numbers, till the market revives, until the category growth go ahead, there's no point in increasing the number of touch points because the cost of reach will become unsustainable.
Right.
So we've not really increased the number of touch points in rural for the last almost 2 years. The environment didn't support that initiative. Right. But as and when rural growth increase, we will scale it up. It's not very difficult to do.
Okay, sir. And so just to understand the base effect, last year Q3, what was the growth from super stockist channel and the general business channel?
I don't remember the number, but definitely the super stockist, which is the rural wholesale channel, has grown at 2x business and substantially ahead of it. So there's been a huge rebalancing in terms of our channel mix, with canteen going down, urban wholesale going down, rural wholesale going up, modern trade increasing reasonably well, e-com, even though the base is very low, increasing exponentially. So it's a very mobile situation. I think directionally we are moving our dependence upon urban wholesale is lessening at a dramatic pace. I personally think e-way bill is going to deal a big blow to urban wholesale because when they ship products across state lines or even when they sell it within state lines, it's all cash dealings and the e-way bill is basically there to stop this kind of stuff. So we'll have to further accelerate our rural outreach in terms of rural wholesale, also urban, more touch points, etc. But things are changing very rapidly on the ground.
Okay, that's very helpful, sir. Thank you.
Thank you.
Thank you. Our next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hello, Mr. Dugal. Just one question. Your commentary on rural was, a bit more cautious than rest of the peers who have reported earnings so far. You have talked about, that the rural market growth rates are fairly, subdued. All the growth has largely come from your own efforts, while others have talked about a gradual improvement. Why is there this divergence, so to say, or is it that the bigger players are basically doing better in rural versus others?
Well, our rural growth, Latika, this time were 23%, 24% over last year. So it was a spectacular performance in rural. Why I am being a little cautious is because the headline numbers, and that's the only data we have access to which is meaningful, show a sharp deceleration in the growth rates. Now, I cannot ignore that metric. While our growths are good and hopefully will remain good, but we have to be prepared that the growth rates the inherent growth may not support our business growth, and we'll have to do something extra. So I don't want to be lulled into some kind of complacency that growths are there, we just have to walk in and take it. We'll have to fight for growth. We should be prepared to fight for the growth through market share gains. Now, like I said, tomorrow could be a very, very different environment where rural economy will take pride of place in the budget. And then we would see the acceleration happen, and but there's no harm in making that extra effort. And I always believe that be prepared for the worst and don't try to be overly optimistic. So that's really the way we run our business. is looking at the worst case scenario.
Right. And the numbers, you are referring to our Nielsen numbers, I'm assuming, right?
Yeah,
The Q1, Q2, Q3 numbers that you talked about earlier.
Yeah, that's one. Every category is showing the same trend in FMCG. So you can, get these numbers yourself and see.
Right. No, we don't get access to them anyway. Thank you.
You don't, but I'm sure you have your methods.
Thank you.
Thank you, ladies and gentlemen. That was our last question. I now hand the floor back to Ms. Gagan Ahluwalia for closing comments. Over to you.
Thank you for joining us for this conference call. A webcast and transcript of the call will be available on our website. We'll be happy to address your further questions, if any. Thank you and have a nice evening.
Thank you, members of the management. Ladies and gentlemen, on behalf of Dabur India Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.